I don't think we finished chapter 3 yet. It's the never-ending chapter, but I think we should be able to not finish chapter 3 handout, and then we'll do the chapter 3 multiple choice. Questions. We'll kind of do that over break. And when we come back, we'll do the monetary unit sampling. Continue with that. Oops. Okay, so that's the plan for tonight. Any question on that? All right. For some reason, I have 2 folders up, and one of them's probably not the right one. Oh, they're both the same one. Couldn't have missed. I guess they're both the same. Okay. So I think we are down here. So I think we got 7. No, we've done 7. We have 8, 9. Hey, and we're done. Okay, that shouldn't take too long. All right. So, types of evidence. So these are all the different kinds of evidence that you'll use to get enough evidence to make an opinion. And again, you have to get enough of this. You have to get sufficient. Appropriate evidence. That is not how you spell appropriate. And you can do it any number of ways. To get enough evidence to make your opinion. One of the things about auditing, because it is it's all judgment, is that you can have take two completely different auditors, and they can be perfectly competent and come up with different ways of getting evidence together to form an opinion. It's not uncommon at all. It's sort of like saying, what's the best way to get to Pittsburgh from here? Well, different people might have, you go on this highway, go on this, go cut through here, whatever. But as long as they get to Pittsburgh, it doesn't really matter too much. It's successful as long as they get to Pittsburgh. It doesn't, it may be more efficient or less efficient in a certain way, but 2 different auditors definitely come up with 2 different ways of doing it. So the amount of evidence and the type of evidence is going to be up to the auditor, up to their judgment. Okay, so this is inspection of records and documents. You can imagine what that is. It's the same, that's what you'd probably expect to see as an auditor, to look at records and that. Inspection of tangible assets. Inspection of tangible assets is a little bit, you may think of it as a little bit less of of an accounting function, but actually that's what you do. And what will happen is tangible assets are things, obviously things here's a tangible asset. Things that you can actually pick up. But in a company, they'd have computers, they'd have desks, they'd have machines, they'd have cars, they'd have trucks, they have all this other stuff that are tangible assets. And one of the things you do is you want to inspect them. If they say that they have 3 company cars, you want to inspect the 3 company cars. that you can actually see them, you know, and go to see them. A lot of times they'll have a tag on them, you know, like if this was an asset, you may have a tag on it. You can take that tag and match it up to what's in the in the books, somewhere in the book, the calculator, but probably not, they probably just expense this when they bought it. But if this is like a, you know, an expensive piece of equipment, you look at the tag, and that tag should match up with something in their detailed ledger about you know, that item. And so we look at the intangible assets. The common way to do it is floor to book. And what that means is that you look at the items, equipment on the floor, and it should be in the should be in the books. This would be the completeness. Test. You know, is everything in there? Book to floor. You'll take some items that are on the books. And this is existence. So you generally do floor to book, book to floor, and again, these are the assertions that you're looking for when you do that. And I used to do that because I worked for Navistar and US Steel, what kind of heavy machine, you know, heavy equipment laden company. So this was always one of the things that we'd always have to do. The one, by the way, that you usually find the most errors with is this one, book to floor, because what happens is, well, let's take this one. When equipment comes in, there's all kinds. There's a receiving report. There's purchase orders. There might be contracts. There's all this stuff that you know, kind of ensures that it's going to get recorded. However, sometimes things on the factory floor, they pull it out, put it out back, and you know, the garbage man comes and picks it up, and no one knows anything about it. So a lot of times you have stuff on your books, or not a lot of times, but sometimes you have stuff on your books that no longer exists because no one ever told you that it was taken out. So this is the one that you usually find problems with. The nice thing is usually it doesn't really matter because usually these are things that are completely depreciated or close to it. But sometimes this is going to be more problematic usually than you know, the floor to book. Usually things that are on the floor will be in the book. It's the other way around that things sometimes are not so good. Observation. Watch people do their job. I know it sounds funny, but that actually you do quite a bit of that in auditing, and there's real art to doing it without being creepy or being, you know, scaring people or something. Whenever you start staring at someone when they're doing their job, they a lot of times they'll assume the worst. But yeah, a lot of times just observing how they do it. And one of the reasons you do that is people will tell you that they do it a certain way, and you can actually read in their, the whatever the guidelines that the company gives that it should be done this way. And then a lot of times you go observe them, and it's completely different. It has nothing to do with any of it. And not that they're necessarily lying to you, it's just that a lot of times they think that it's being done that way. I've come back and had supervisors tell me that they do it this way, and I go out and look at it, isn't done that way at all. And they're completely surprised. Really, we're not doing it that way? No, we haven't done that way for 7 years. And again, they're usually not being bad about it. It's usually just that's why they think it's being done. And so, but the point being is, if you want to get accurate information, a lot of times observing them is much better than having them tell you or looking through the documents. You look through the documents, it'll tell you one thing. Ask them something, it'll tell you one thing. And then you go watch people do it, and it's completely different. I audited for a little more than 3 years. And it's kind of funny because by the end, by like the last year of my audit, I realized I didn't even ask people what they did. I just went out and started observing them, and then kind of put the things together. Because so often you document all this stuff. They said do this, this, and this. And you're writing it all down. You take all this time, and then you just throw it in the garbage can. So a lot of times I would just go observe them. And, that would again, not because they're being bad, just because it's just easier. Inquiry. Asking people. Ooh, so let's try that a little differently. Ask the client's employees. Sometimes they'll be high up employees you'll be asking. Sometimes there'll be people right on the work floor that you'll be asking different questions to. And it actually you try to build up a rapport a little bit. Sometimes it's hard because you're not there very long, but if you can, you try to get employees to answer things honestly, and so you get a real picture of what is going on. And by the way, I'll tell you something about fraud. It's unbelievable how many times people will be asked, did you know fraud was going on? They'll say, yeah. Say, okay, well, why didn't you tell me what? No one asked. And it's amazing how many times fraud is caught by someone simply asking, do you know of any fraud? They'll sit there silently if you don't ask. But if you ask them directly, a lot of times they won't lie. They'll say, yeah, there's fraud going on. And so one of the things you do ask, of any fraud going on. And it's amazing how many times fraud gets caught that way. Because again, people will look the other way, if it doesn't seem like it involves them. But if you ask them directly, a lot of times they won't. They'll just say, look, yeah, you got to look at the whatever, there are problems. Okay. Confirmations. This is a whole class by itself, pretty much. A lot of times you'll send confirmations to third parties, and the most common one you'll see is confirmations to accounts receivable. Did I already talk about this? I can't remember. Let's say for accounts receivable. This is actually one that's required. All right. So confirmations for accounts receivable. Basic confirmations are to any third party. But one of the common ones is accounts receivable. And accounts receivable is common because these are sales that are being made. And so, for instance, you may have the the seller's invoice, let's say, which in this case, seller's invoice, if your client's a seller, it's an internal document, and it is not very good evidence. So, here's the problem. This is a weak evidence. So what you do is you send out a confirmation to the whoever the accounts receivable is for, and say, look, do you owe this amount? Show some amount on there, and they'll say yes or no. And you use that as a third party confirming what's in that account. There's a whole slew of things to do with that, but the idea is it's a third party. So you're taking an invoice, which is lousy evidence, internally generated, and turning that into good evidence by getting a confirmation. So the confirmation of accounts receivable, and in the U.S. standard, it's required, and the international standards, it's not. It's encouraged, but not required. But so anyway, as a confirmation, so it's a third party, the customers, and it's to confirm that these accounts receivable that the client has on their books, that they're real, that they are actually exist. Okay. Recalculation. This would be, for example, you might recalculate how they come up with their uncollectible accounts expense. How do they come up with it? You see what method they use, and then go ahead and recalculate it and see. Depreciation is another one that commonly is. Another one you can recalculate. And generally speaking, your recalculations are of better evidence, right? They may give you what they're. You hear that rodeo in the background? That's the new dog we got. Thing's a complete nut. Anyway, but these are recalculation. It's better evidence than simply getting it from the client. So the client might give you, this is how we calculated our uncollectible accounts expense. You may take their method and go through and do the recalculation of it and just see, did they do it correctly? Is what they're giving us really how they, following the method that they showed us and all that kind of stuff. Reperformance is actually doing the entire thing. So I'll tell you a funny one that I did. I don't know if I told you guys that, maybe I did, but I was doing an audit. We had an audit where they had a problem with the inventory. The inventory that was being returned wasn't being put into the warehouse system. They would give credit to when someone returned something, they give them a credit, but the returned items were never put back into inventory. Even if they were placed in inventory on the books, they weren't put in inventory. So it was like this ghost inventory. And usually when you do an inventory count, usually there are things that are less. It usually comes up less than the total. Why? Theft, breakage, those kinds of things. Someone returns something that can't be resold. So a lot of times, something falls off the forklift, it gets broken, they throw it in the garbage can or whatever. Usually when you do an audit of the inventory, the inventory gets reduced. Usually there's things that are missing. We do this audit and there's all this extra inventory. Like a lot, like millions of dollars worth of inventory just showed up in our book. So going through it, we found out that it was the way that they were taking inventory back, returned inventory, and not getting into their system. And it was one of those muddled up things that they had a new system and no one knew how it worked and all this stuff. And I remember so my some of my supervisor, and I was the inventory guy. I think I told you guys that. But I'm mostly audits. I was the inventory guy. So anyway, I told my boss about this, and my supervisor, and he said, "Well, you go do it. Go do the entire thing from start to finish." And I said, "Well, you mean like watch them?" No. You do it. You go through them. So, and they had these things that in the warehouse. These I don't know what they're called. They're like they're not really like forklifts, like scissor lifts or something. That you go up like 40 feet or something in these things. I don't like heights, but I I just did. And it was kind of terrifying. One time I was up like 20 some feet up in there, and you're on this little rickety thing, and it's wiggling around. And all the other people that do it every day are just zipping around on these things, picking stuff, and it's taking me like a half hour to return like 2 things to. But anyway, it gave us insight into how and why these things were not being recorded, and it came down to they didn't want them recorded until they're actually in the bins, but there was no confirmation that they were in the bins to begin. There was a missing piece there, that the things would be put back in where they're supposed to go, but the confirmation of that was never given, so it was never put back into inventory. There was like a missing link in the system. It was a new system, and for whatever reason that wasn't in there. But anyway, that was reperformance, where I went through and did from start to finish. When something gets returned, how they match it up, how they did everything until it got put in, and then and that was that was one of the things that we did just to figure it out. By the way, this place had a union, and I was hoping that the union would say I didn't have to do it. Like, oh no, you can't do that. That's a union job. But yeah, go ahead. I don't care. So I had to go up and it's crazy contraption. All right. So that's what performance is. Analytical procedures. I think we talked about those, didn't we? Maybe we did. They're basically, usually they're ratios. So your ratio analysis, you can come to your current ratio and all that kind of stuff. Those are analytical. Those are used as analytical procedures. And what they do is they look for plausible relationships. Plausible relationships between data, and it could be financial data or other data. So, but plausible relationships. Let me give you an example. I may have already done this one. Plausible relation, let's say sales increases so fast I can't spell it right. Sales increases. You would expect so we have our sales increases by whatever amount. What would you expect would happen to selling expenses? Would they go up or down? What would be a plausible relationship?
They should increase as well.
Exactly. They can go up as well. You expect they go up as well. Either how they make them more sales, either more advertising, or pay more commissions, or whatever. You'd expect that they would also increase. Now, if they don't increase, so let's say that the sales go up and the selling expenses go down, is that evidence of fraud? So you expect that the selling expense to go down. Their sales go up. You say, okay, selling expense should go up. That's plausible. Or plausible relationship is that more sales, the more selling expenses go up. So if they have their sales go up and their expenses go down.
Not necessarily. It depends on if they change some things.
That's absolutely right. It depends. Now, here's what analytical procedures do, though. If that were to happen, they'd say you might want to look at those selling expenses because that's not the relationship we expected. We expected it to go up.
Right.
So analytical procedures generally aren't evidence of fraud or misstatement. What they do is they kind of point you in the right direction. Say, okay, go take a look at this because this looks funny. And about 95% of fraud is caught through analytical procedures, of financial statement fraud is caught through analytical procedures, not because of themselves, but they kind of point you where to go.
Okay.
Where am I at here? Okay. So these are. So I'm not sure exactly. I think it varies between 90 and 99% or whatever. But let's say 95% of financial statement fraud is caught this way. And again, they are not, first of all, that's not spelling financial statement fraud. They're not generally themselves evidence. However, they are used for identifying things that you need to look at. You know, when someone's cooking the books, a lot of times, you know, it's not going to make sense. For instance, if they put a fictitious sale on the books, okay, well, so they put accounts receivable for some fictitious amount, they're not going to collect that. So there's going to be some kind of a relationship between sales and cash that's not going to be there, because if they put a fake sale on the books, no one, it's fake. They're never going to see that money. So there's always some relationship. Whenever someone tries to do something with the books, to cook the books, there's always a relationship with other data on the books. And that's kind of why this, the procedures picks this stuff out. Scanning data, just looking through the data itself, scanning through the accounts, looking for unusual accounts. What do you look for? Non-routine accounts, or entries, I should say. For instance, all the sales you'd expect to come through the sales journal. Well, if there's a sale that doesn't come through the sales journal, that's, you know, why isn't it going through there? So you look for non-routine, you look for large numbers. Look for nice round numbers. One of the weird things about fraud is a lot of times it's for nice round numbers, 5,000, 10,000, 15,000, that sort of thing. You would think that people perpetrating it wouldn't do that, but incredibly and thankfully for us, a lot of times they do. So you're looking for these kind of unusual things that you might want to look at. And the large numbers, obviously, you want to look at the large numbers just because they're large numbers. You're looking for things that are material. Okay. And the last thing we're going to do here, and these are they're not too. Okay, who owns the audit documentation? We may have already talked about this. The auditors own the documentation. So auditors own the documentation. Now, these are, however, confidential. So even though you own the information, you cannot just go out and put it on the internet. You know, if you're doing an audit of IBM, you can't go out and put the work papers on the internet saying, look, this is the audit we just did of IBM. And you wouldn't want to do that anyway. We'll talk about that in a second. And basically, you're going to need some kind of a court order, usually a subpoena, before you release the information to the courts even. So if there is a court case or something, they need a subpoena. How do you spell subpoena? That can't be right. Let's see if he gives me the right answer. There we go. Oh, I was way off. Look at that. Left out half the word. Before releasing, and it must be a subpoena. You know, you'll have lawyers send you letters saying we need this, and you just ignore it. Say, okay, you need to go get a subpoena. And now here's the thing though, too, and that is you also don't give the work papers to the client. And there's some reasons why you don't do that. First of all, there are things that are confidential between employees that you don't want to release. For instance, maybe someone was, you got information that somebody was committing embezzling money or something, and you look into it and there's no truth to it. You'll have that in the work papers, but you don't want that getting out. It's not true, and you know that's not something that everybody should know about, especially because it's not true, is it? So there are things in there that are confidential even between employees, but also you don't want the client to know exactly how you test their work. You don't want to tell them how much, for instance, materiality is. If they know that your materiality is $80,000, well, then they know they can cook the books for $70,000, right? So you don't want that information out there. You don't want to let them know how you actually do the testing. They probably have some inkling of how you do it because you're doing it on site usually. But you do not want to let them know, how you pick your sample, all that kind of stuff, because they could use that in the future. So you do not share your work papers with the client. The only time that you really would do that is if they wanted to make corrections. For instance, if you tested accounts receivable and there was 8 accounts receivable that were wrong, it'd be reasonable for them to say, can you give us the documentation on that so that we can update our system and correct those 8 accounts receivable in our system? If it's already been found, let's go ahead and correct our system and then, avoid future problems. That's completely reasonable. So if there's a specific thing, you can definitely share it with them that way. But as far as like giving, here's our work papers, you can take a look at all you want. You don't do that. And you don't do that because you don't want them, those are confidential, even from the client. So, okay. And a lot of these are just documenting the things that you would expect, that they document your planning, performance, and supervision of the audit. These first two, plan and perform the audit, are probably ones that you would expect. Supervision is a big thing in auditing, and everything you do will get looked at by your senior, manager, the partner. There might be 5 people that look at your stuff. So the supervision is a big part of it. Now, the work papers should support your audit report. So this is going to have all your evidence. And basically, your work papers are what you're going to bring into court if you get sued. So if someone sues you for something going into court, you are going to bring in your work papers and say, oh, no, we did our job. We did what we were supposed to do. And, this is our evidence of how we did it. I'm putting extra letters on there. I think work papers is one, maybe it's not, maybe it's 2 words. Okay. And working paper review. This one is a little different, and that is your work papers will be reviewed by somebody else in the CPA firm. So if someone in the CPA firm, reviewed by someone in the CPA firm. And usually someone who is not on the audit, they're independent of the audit. Okay, now here's where it gets a little bit strange. For the AICPA, it can come after the report is released. For the PCAOB, it must be before audit report released. And you remember that the AICPA, this is usually for the non-issuers. And this is for issuers. So these are for publicly traded companies. So for publicly traded companies, they are a little bit more strict. And for publicly traded companies, they'll say, no, before you release them, you have to have the review. So someone will come in who's not connected with the audit and review the work papers before the audit report is released for the PCAOB. For the AICPA, it can happen afterwards. PCAOB, they're a little more strict. They say, the publicly traded companies, they say, look, this is a good, it's good to have someone else with fresh eyes take a look at this thing before it goes out, rather than try to mop it up afterwards if something's wrong. Okay. A lot of times you'll break up work papers into 2 different categories: permanent files and current files. And the current files are really probably the easiest to think about. They're for the current year's audit. And this is usually what we think about when we're doing the audit, is the current year file. This is when you're doing all your testing. This is how you plan. This is where you're, if you find any documents that you need to make copies of, you make copies of the documents. You get all your evidence and all that kind of stuff. You get the financial statements for the current year and all this. So these are really things that are for the current year. Oh, excuse me, I bored myself. Permanent file. These are things you go from year to year. For instance, things from the corporate charter. Your first audit, you probably will get the corporate charter and see what things are in the corporate charter, things that are important, what rules they have for whatever, hiring or firing people and all this kind of stuff. You don't have to get that every single year. The corporate charter is probably not going to change. If it does change, you'll update it. Chart of accounts, that's usually going to be pretty much stable from year to year. Organizational chart, you'll probably update this. Usually it would be unusual to have all of the higher ups in the company, all the senior people change, but Every year there might be one or two that make a change or get shuffled around or something. Copies of important contracts with banks or with their loans or with their bonds or anything like that. The documentation of internal control from one year to the next so that you can build on it. A lot of times, if there's any problems with internal control. In terms of stacking the prior year analytical procedure results. So what'd you look at last year basically is going to be in there. One thing that you sometimes will have in there that they don't list in the book, and that is it's not unusual to have the prior year's balance sheet. And because a lot of times, the end of one year becomes the beginning of the next. So for example, 2020, let's see. I'm writing crazy things. That's what they can see it. The ending inventory will become the beginning inventory in the 2021 beginning inventory. Right. So you may have the prior year's balance sheet on because it has the 2020 ending inventory. Why? Because that will be the beginning inventory 2021. So it's not unusual to have the prior year's balance sheet or even just the balance sheet accounts in the permanent file. Oh, excuse me. I think I'm yawning from just the excitement, the anticipation. That's what it is. You guys having that too? Okay.
So can you go back down to wait, go back up. Right. Oh, wait. I'm sorry. Down a little bit. It didn't stop. Right there. Right there.
Yeah. So the prior year's balance sheet. This is the kind of one I added. Let's make it in. Ooh, look at that. And again, so sometimes the prior sheet balance sheet accounts, and only because the ending balances on the balance sheet will become the beginning balances the next year. And so, the beginning balances should be able to be tied to that ending inventory of, say, last year.
Mm-hmm.
I don't know if I take time to go over this or not, but
I got it. Thanks.
No, but I actually had a problem with this one time. This is usually like a 5-minute job to check out the beginning inventory. You see what the ending inventory was last year, and you check out, so you tie it to the beginning inventory this year. And I think I may have already told you that. But I was on a job that it didn't match. It wasn't off by a lot, but it bugged me because it was, it was close. But it didn't match. Usually, whatever the ending is becomes the beginning. And they had the ending was one number, and the beginning was a different number. And I go through that. I went through it, and when I started talking to people in accounting and IT, they were kind of sheepish. And I said, "Okay, look, they got a new purchasing guy in, who was when he was negotiating contracts, he would not only negotiate for the current year, he negotiated changes for the previous year. It was already done." So, and then he would insist. He kept insisting that they change the amounts in the inventory account to the new accounts that he negotiated, and these were amounts that were already on the books, already been paid. The transaction was over, but he I don't know what he was supposed to be like some real hotshot purchasing guy that they hired anyway. And he would like insist that they change, so they did, which was wrong. It was actually we wrote it off. I kind of felt bad because we wrote up the accounting and the IT people for it, when really it was this one. And so I talked to this guy, and I said, "Well, okay, this has already been done, so this is just a dollar change, so we can just put through like a credit, on the book, so if you knocked him down on this, okay, we put in, he said, well, that's what they kept telling me to do. That's not right. Like, they kept telling you to do it because that's what you negotiated in the following year. So it should be in the following year that you recognize that. But anyway, it didn't match up, and that was the reason why. And then the kicker to that is the guy, before we finished the audit, the guy had actually quit, which I think everyone was, not us, but I mean everyone in the place because he was not. But anyway, okay, so here's what we're gonna do now. I think we'll go ahead and you guys have the nope, not that. The multiple choice questions.
Mm-hmm.
So I think what we'll do is you can take a break now and come back, and I think that we'll go ahead and go through those, and I'll put one of the polls up. And so you can put the, when you use the answer, I have two of them. There's 20 multiple choice questions. Zoom only lets polls be 10 questions long. So I have 10, so you have to do one poll and then do the other. So anyway, so if you could at least go through, say, the first the 10 questions. So we'll take a break. What time is it? 6:40. Let's say we'll come back at maybe, let's say, well, 7:10. Like about 10 minutes for a break, about 10 minutes to kind of go over. So what we'll do is go ahead and enter these, and I'll give you guys extra credit points based on it. And let's see here. Oops. I shared wrong again. Okay. And so let's say, say feedback and say 7:10, and we'll go over the multiple choice questions. And we'll go over those. So do the multiple choice questions now for the handout for this thing. And by the way, these are all anonymous, so don't be afraid of putting the wrong thing in. I should have done this. Oops. Sorry about that. Well, I'm glad you didn't hear my cough. But is anyone still working on it? Is there anyone that needs a little more time? If you do, say something, or else you can put it in the chat. If you just private me in
Yeah,
the
can
chat.
I get like 2 more minutes?
Absolutely.
Wait, I was only able to do the first 10 questions. Is that right?
Yeah, that's fine. Yep. Okay, is anyone else still working on it? If you need more time, you can either private chat me or just say if you need more time. Everyone's in. Yay, everyone. Okay, so I'm going to go ahead and share these. Polling. Share results. Oh, I almost clicked relaunch polling. That would have been a bad thing. Okay. So what we're going to do, go through these and see how you did. Okay. Question 1, D is correct. Oops. Yeah, so integrity of management. And that now here's the thing. This is you know, if they're not letting you see something, that indicates that there's some reason why they're not letting you, you know, so anything that they try to keep you from seeing. So if they're trying to keep you from the predecessor auditor, that's kind of a red flag. Question 2. Yep, D, all of these. And here's another one that, you know, these answering any one of these is not incorrect. But remember the CPA exam, I think I told you guys this. You look for the best answer, and the best answer is all of these. This one, I don't think we've talked about this. Financial health of a prospective client. So one of the things you look for is if the client is going bankrupt, you know, or doing poorly, maybe a better term, but oops. You know, why would you care about that? Why would you care about, you know, if you know, they can still have their different, if they're going bankrupt, their financial statements could be done correctly, right? I mean, they'll look bad, but they can be done correctly. So why would you worry about the financial health of the prospective client? Why do you think you'd worry about that?
They could be lying about their numbers.
Yeah, for one thing, yeah, there could be a couple reasons. For one thing, they have more incentive. Not that they would act on it, but they have more incentive um, uh, to lie. I just got a message. Yeah, it could be that they might not be able to pay you. That's also a problem if they can't pay you. Also, and this is even probably more severe than you may think, but if there is a problem, if the company does go bankrupt, people are going to be unhappy, and so the people that they're owed money and that sort of thing, who are they going to sue? They can't sue the company. The company's bankrupt. The only people left with money are the auditors. So a lot of times the auditors will be sued, even if it's not, if they have nothing to do with it. A lot of times they will be sued. And once you get into a lawsuit, I mean, any profit that you had built into your audit is probably going to be gone. So taking on a client that's doing poorly or possibly going bankrupt is actually a very risky thing to do. It also occurs sometimes when you have a client that isn't risky but becomes risky. That when you take them on as a client, they're doing fine, but then as time goes on, the business starts to suffer, and that's a real problem. You cannot simply withdraw from an audit and leave them in the lurch. One of the things about being a professional is that you can't leave a client in a worse position than they were before. It's similar to what you have with lawyers. If lawyers, you can't just quit a client if you're a lawyer. You have to go to the judge and they have to prove it and all that kind of stuff. Same thing. And so, but it can be, it's risky to have a client that's going bankrupt or close to it.
Professor, I have a question.
Yeah.
How would it be okay that they could sue the auditors for them being bankrupt?
Well, the lawsuits would come from creditors. Yeah, and the question of would they be successful? That's something different. And for the most part, if you do your job and if you are competently do your job and you put out put your audit report that reflects the financial statements that they're not materially misstated, there's usually not a problem. One thing you got to remember too is that for what we're doing, we give an opinion. We don't give a statement of fact.
Mm-hmm.
So what's an opinion? In my opinion, the color blue is the best color. That's an opinion, but now we have a more informed opinion when we do the financial statements, but at the same time, so lawsuits are not always successful when people bring them, but just someone bringing a lawsuit a lot of times means that you're going to lose money. You got to get lawyers, you got to get, what I mean? So a lot of times the lawsuits are, even if they're not successful, you still want to avoid them.
Okay.
Yeah, but it does happen, and especially in this country, lawsuits fly all the time, and they're successful a lot less often than you would think, but it's still not. I'll put it this way: you're more likely to get sued when things go bad rather than when they're going well. Company's doing well, you're probably not going to get sued. Company's doing poorly, it becomes more likely that you're going to get sued. It's one of the weird things about the United States. You wouldn't believe the lawsuits, in the United States compared to the rest of the world is this. Well, for instance, in the United States, it's required that you talk to lawyers when you do an audit. They don't have that in other countries because they don't have the crazy lawsuits. And not only don't they have as many lawsuits, they don't have, there's no jury going to award $50 million to somebody. They have, this is how much people get paid for this kind of injury and all that kind of stuff. It's not the same as here. And that one of the big eye-opening things is when other countries came and invested in the United States, that they could get hit with lawsuits that were tens and hundreds of millions of dollars. It was completely foreign, completely foreign to them. That could happen.
Is
But
it
yeah, go ahead.
is it because they're more like the countries? Is it because of like collectivism? Like they believe that, I don't know. I think they don't. Some,
Yeah. But part of it is that money comes from somewhere, and that if you sue a city and you get $10 million, people say you who they get them. Well, that has to come out of somewhere, and that comes out of programs for other people and other, what I mean? So yeah, they do have a very different view of it than we do, and it's significant, and it's because of our legal system, that they really it really is different than in other countries. And so yeah, the lawsuits though, a lot of times the minute you get into a lawsuit, any profit that you had built into that audit is probably going to go. And it's also true, someone mentioned here that you may not even get paid. You may not get paid yourself. You may be in line with the other creditors trying to get paid. Now, there is something also about auditing in that if they haven't paid your fee for the previous year, you cannot take the audit. And the reason is you're not independent. At that point, you're a creditor to them. You're lending them money, and you have a financial interest in the company, in them succeeding. So if there are unpaid audit fees, that makes you not, you can't take the audit because you lack independence. So there is that, and you can not take the audit because you can't. You're not independent. Okay. So let's see here. Oops. You know what I hate about computers nowadays? Like all these programs, they guess at what you want to do. I hate that. All right. Question 3. Which of the following should an auditor obtain from the predecessor auditor prior to accepting the audit engagement?
is it D?
Yep.
I accept my bearing.
Yep, you guys got it right. It's D. And all matters of continuing accounting significance. You're probably not going to get too far into that. That's not a bad answer, by the way. If it wasn't for this last one, that might be one that it's certainly better than these two. But this one, you're probably not going to get too far into that until you actually take the audit. So this is prior to the audit, and that's something you'd probably do after the audit. You're really looking at can we trust management? Is this something that we want to do? Okay, which of the factors would cause a CPA not to accept a new audit client?
For that question, you had D and D for your answers, though. But
I did that in another class too. I gotta go back. You know what? I'm gonna write that down right now because I gotta fix this class. So I gotta fix the multiple choice in 330, and I also gotta fix it in my 210 class. Okay. Sorry about that. You're right.
okay.
There's 2 Ds. That's my new alphabet I'm working with, you guys. I'm trying to combine letters, so C and D will be 1 now, and just really streamline things. Okay. Yeah, because this will reflect on their integrity. Now, some of these, for lack of understanding, as long as you can get the understanding, you can take the audit. They didn't investigate their employees. This one right here, you might say, well, wait a minute, aren't we supposed to talk with the predecessor auditor? You are if you can. It's possible that the predecessor auditor has died, left the country. There are reasons why you might not be able to do that. Sometimes people just get up and leave. So you ask the client, can I talk to your previous auditor? Yeah, if you can find them, I can go ahead. Okay,
Okay, so 4 was A, and when they say permit to inquire of his legal counsel, what do they mean by that?
that's kind of what I just talked about. Yeah, you're required to talk to the lawyers.
Oh, they're lawyers.
Yeah.
Okay, got it.
So you say, and you want to be upfront when you're talking with someone about doing their audit and say, look, one of the things we got to do is talk to your, previous auditor. We also have to talk to your lawyers. And then if they say, well, you're not talking to my lawyer. I say, well, okay, well,
Then you don't want to take them.
yeah, then we're not taking the audit because we have
Okay,
to.
got it.
Yeah. And we're required to. So, okay, 5. 5 is, you got this right. This is a tough one. Yeah, so what would most likely lead to conclude the potential? If you don't think you can get enough evidence to support an opinion, you shouldn't take the audit. The whole audit, the point of the audit is to make you form an opinion. So if you don't get that, that's your biggest. You won't be able to complete it. Some of this other stuff, detailed transactions and they're not available at a specific period of time. This could be a problem too. There's, that's a reasonable one. Management has a reputation consulting with several accounting firms about significant accounting issues. That's okay too. That could be a problem. It could be a problem. There's a thing called shopping for principals. Shopping for principals is when, I know I do that. Shopping for principals. Shopping for principals is when you tell a client they can't do something. And they say, well, okay, you're not the only CPA firm in the world. We'll go get somebody else that will. If you say we can't account for it this way, we'll find somebody who does. So they go around and start shopping for accounting principles. And what they do, they kind of, they call the different CPA firms and they say, by the way, we're accounting for income, for revenue this way. Would you have a problem with that? They say yes, they hang up and call the next one. So that's called shopping for principles. It's very much frowned upon. Does it happen? I'm sure it does. Okay, number 6. Before accepting an engagement, the CPA is required to obtain until they're a client, you're probably not going to want to do most of it. You're not sure that gave an engagement letter until they're a client. Yeah, so this is, you guys are absolutely right. That's it. Again, these are things you'll do. It's just that you won't do them before you take them in as a client. There are things to do. And, these are other things you'll do, but usually after you take them as a client. Which of the following situations? Car, special order bank, yep. Inventory. This is one of the funny things that always comes up. This is for you bring in a specialist. So in this case, a specialist is like a gemologist. I have no idea if I'm spelling that right. But the reason I laugh is that in the CPA exams, gemologists get an inordinate amount of attention. Okay, question 8. To provide the greatest degree of independence in performing internal audit activities, the function should report to, yes, the audit committee and the board of directors. They will probably report to other places in there, but they should go to the audit committee and board of directors. And I think I told you when I was auditing the 2 companies I audited with, we would send our internal audit reports to board of directors, audit committee, and the external auditors. we would also send the external auditors our reports too, just so they know what's going on. All the following refer to the competence of the audit. So this is an important word. This is a very specific thing. The competence of internal audit firm, except, and you guys have this right. Yay. The party to which our function reports. This has to do with the objectivity. The rest of these are all about competence. This one is about are they objective? For instance, do they report to the board of directors, the audit committee, and that sort of thing. Independent auditor might consider the procedures performed in internal audit function because this is somewhat of a tricky one, and you guys got it. It's B. Good. Okay. Yeah, and by the way, when you look up here, this one says the employee's work must be, the key word here that kind of knocks this one out, just so you know, is the must. They don't have to use the internal auditor's work. They can, they may, but they don't have to use it. That's not bad one either, this last one. Yeah, it could be. This is usually the best one, though. You might rely on it. Okay. Do you guys want to do the next 10? Let me ask it differently. Have you done the next 10 or no?
Yeah.
Okay, we'll do the next 10. We might not get, you know what, we probably won't get to the, well, we'll see when we finish up. Okay, so I'm going to stop sharing results. And I got to put the next one up. Okay. Yeah, these are good. You know, a lot of these are actually CPA questions, and they make you think. Check and make sure these don't have any duplicate ones. Okay, does anyone need more time? If you need more time, let me know. Either in the you can chat. You can do a private chat if you want.
I need just about 1 more minute. I'm on the last one.
Take your time. No problem at all. Can you guys hear that? I'm in the basement. That's a dog. That's like a 10-pound dog going nuts upstairs.
I'm done, Professor.
Okay, and let's share the results and let's see where we landed. Okay. So emphasize independence. The public trade companies are required to appoint a partner of the CPA firm. No, we're not going to do that. Now, being on the board of directors, the problem with a CPA being on the board of directors is that you're not independent. The board of directors is an overview function, and so you don't want to have anyone on the board of directors. As a matter of fact, if anyone in the CPA firm is on the board of directors, regardless whether they do the audit, the whole audit firm is not independent. Okay. Yep. The independent auditor is to report to the audit committee. You'll report anything that is significant or material. I don't think we talked about that. And what significant is a lower level than material. But it sounds like a rodeo going on upstairs. So just for example, maybe significant is $10,000, whereas material is $50,000. And so by definition, anything that is significant is also material. I said that wrong. Anything that is material by definition is also significant. So whenever they have any rules on significance, that also applies to things that are material. But yeah, you're required to report to the board of directors anything that is significant or material. D, let's see here. Another pays odds about a new client's industry in order to, yep, D. Some of these other ones aren't bad. And some of these are true, they just don't answer the question. This is absolutely true. You should develop a professional skepticism about management that is required. It's a true thing. It's something you need to do. It just doesn't answer the question is the only thing. And by the way, CPA questions are like that. a lot of times they'll have answers that are true, but that don't relate to the question. Kind of a mean thing to do, but yes, related party transaction. And by the way, at no charge, there's a couple problems with this. So they occupy the space at no charge in office building owned by the shareholder. So part of the problem is, notice that this would reduce the expense for the business. It might make them look more profitable than they really are. Right. So part of the problem is that this reduces the expenses, makes it look more profitable. The second problem with this is that this is really additional owner investment. Into the business. This is sort of like buying more stock. If you're giving them, $1,000, place you could rent for $1,000 and you're giving it to them for free, that's additional owner investment, and that should be picked up in the balance sheet. So the first one is it makes it look more profitable than it really is. The second problem is that really is additional owner, the owners are actually putting more money into the place. Which of the following would not necessarily be a related party transaction? Excuse me.
Sales to another corporation with similar name.
Yeah, let's not do it. Now, someone picked C. C isn't necessarily a bad one, and that is if the loan comes about through normal business. For instance, they buy a car and they get financing through a bank, and the bank is a client or something like that. That's not, if it's part of normal business, that's not necessarily a related party transaction. But it does. You would have to look into it to see if that was all at arm's length and all that. But the best one here is going to be this one, yeah, because this has no relation to them. Okay. Yes. And these are for the dollar amounts. So some of the procedures are tested details. That's looking like invoices and things like that. The account balances, and also analytical procedures can be used. It's a very rare thing, but they can be used for substantive procedures. I hate explaining this one, but like industry averages for bad debt expense, for instance, can be used. That's about the only one I can think of. Now, this one may be eliminated under certain conditions. That is not, you can't do that generally. Yeah, so the ones you can eliminate are tested controls. If you're not going to rely on them and it's not publicly traded, you can eliminate those. But total misstatement is yes. The misstatement will be to an assertion, but the assertion will be for a specific account. So if how much it's misstated by, and you will use the financial statements as a whole, but then you'll break it down to each individual account for the total misstatement. This is the new terminology for this is, I should put it up here. The new terminology is performance materiality. I have no idea how they came up with that term. I guess maybe you're performing the audit, but that's what you're going to be looking at, maybe. But these are both account specific. So, cash, accounts receivable, etc. you know, how much we allow cash to be out by, how much we allow accounts receivable to be out by. That's specific, and we will do the testing, and that'll be a tolerable misstatement for that specific account. And this is virtually always going to be less than the total materiality. You may say it can be misstated by 100,000, but for this account, maybe it's 5,000 or 10,000. Like that. Okay, you guys are doing great here. 17. I should have said that. Jinxed it. Which of the following is not qualitative? So qualitative means that it's something beyond the numbers. So you guys got that one too. This materiality at 4% of pre-tax income. That's that's a dollar amount. These other ones are all qualitative. Potential fraud, company close to violating a loan. Interrupt the trend. Okay, let's see here. 18. Study determination of timing of the audit, is it? Yes, and here's the thing. You generally, you do not want the client to know some of these things. You don't want them to know that. This one they probably already know. Oops, I didn't mean to do that. You don't want to tell them what evidence you're looking for. You don't want to give them anything that might allow them to, to manipulate whatever it is they're doing, so that they can avoid being detected doing something. So you kind of play your hands, close to the vest, and that you don't tell them anything. Now, the timing of the audit, you have to tell them when you're going to be there and that sort of thing. It's not, and for instance, like taking inventory and that, they have to be there. Sarbanes-Oxley, all of those. Very good. And those of you that answer for these other ones, the other ones are true. There's nothing, these are absolutely true. It's just, this is the best one.
Professor, I have a question.
Yeah.
For the CPA, would you say that more times than not, when we see the answer, all of the above, is that the right answer?
It's hard to say, and the reason I say that is I'm not sure. I'll tell you. I'll tell you why. The CPA exam. The CPA exam is it's a closed exam now. When I went through, it was an open exam, and what I mean by that is you'd go in and they give you a sheet with the exam on it, and they give you an answer sheet. And you fill out the answer sheet, hand it in. You take the actual exam itself, you put it in a self-addressed envelope, and they would mail it to you. You'd actually get back the test you took with your, anything you wrote on it would be on there. It was an open test. And that was in 1996. I don't know what the CPA questions are now. What the usual, it could be that what you're saying is correct, but I really don't know. There's two reasons for that. You can lose your license basically if you tell somebody what's on the CPA exam. It's an ethics violation. You can also lose your license if you ask somebody what's on the CPA exam. So people who've taken the CPA exam will know I never asked them specifically what was on the exam. I might ask them what kind of questions, what topics were on there, but never like what the questions were. Just because it's it's illegal. It's so anyway, yeah. Hard to say what they would normally do. That question specifically that we were just on that would not have been, the Sarbanes-Oxley Act came about in 2003. So this would, I would have never seen this, up through 1996, it wouldn't have been on here because this act came in let's say 2003. So there probably are no official CPA questions floating around that relate to that. Unless somebody, lifted them from, but I'm not sure. Yeah.
It just made me wonder because we had two of these type of questions and they were both all of the above. And I remember back in high school, it was kind of a rule of thumb for the driver's ed test that all of the questions that had.
It could.
But I mean, obviously, you can't compare driver's ed test with a CPA. So it just made me.
It could be, and and if they do seem reasonable, if they don't have anything crazy in them, I would say you might, might be that they're all above. Having said that, definitely read the question though before you come to that conclusion. If they have something crazy in there, it's not, it's not that one. All right.
I usually choose it if I see at least 2 or possibly 3 of the questions making sense,
Yep. Yeah. You're right. If two,
you can't choose one or the other. If 2 of them actually is a go, then
right.
it has to be D because the other one would only have to be included,
Right. You're absolutely right. If 2 of them are correct, then it has to be all the above.
For sure that 2 of them is, then
right.
I would just go with
That's definitely a logic that you would definitely have to use because if 2 of them are correct, you can't put A and B.
You got to read it really well though.
20. Which is the following relatively small mistake with likely material effect? Illegal payment to a foreign official. Yes, and yeah, you guys got 100%. All right. Well, we'll add 5 onto the test. Yeah, this is the Foreign Corrupt Practices Act, and this is a felony. I don't think I should have to say this to you guys, but don't bribe foreign officials. Obsolete equipment, that's not going to petty cash. Petty cash by definition is petty. It's immaterial. Uncollectible accounts receivable is not written off. That's not going to have any impact on the value because they'll probably have it set aside anyways for, in the allowance for uncollectible accounts. They just haven't written it off yet. So yeah, this is definitely one. Illegal payment would definitely bump it up to be qualitative. That's qualitative. Okay. Well, we're done with chapter 3, so you guys probably want to test on this, don't you? I know the way you college kids do. All right. Yeah, so I will send out a test for chapter 3. We're not going to do the but we're going to push the monetary unit sampling off till next. Stop sharing results. Okay, so I'll make up a test to send out. There'll be something similar to the stuff that we just went over and some stuff out of the handout. I know that handout's pretty long. It'd probably be similar to what we did last time. Problem or two, maybe. I can't remember. I think it was 3 or 4 problems out of the multiple choice, and then probably 2 or 3 essay questions. And I'll get that out by tomorrow. I'll try to get it out tonight, but I'm more than likely to be out tomorrow. And then I'll give you guys until, I usually give you guys a week plus 1 day. So when I send it out, it'll be due on
Saturday, next Saturday.
Yeah. Yeah, so it'll be due next Saturday. Now, again, you guys, the due dates are just kind of keep you on track. But if you're missing something, turn it in. I don't take off for it. So if you are missing something, go ahead and turn it in and get the grade for it.
Will we be turning anything in for like this chapter? Like, are you going to open up something for chapter 3 for us to turn in stuff?
The chapter 3 handout, will be turned in, and then the chapter 3 exam. I think that's only 2 things that I'll put on there.
Okay.
What about this multiple choice that
Yeah,
we just did?
multiple choice.
Well, you guys, I take this off, but there's this records who was at the who's on the at the Zoom meeting, and if you're in the Zoom meeting, you get +5 added on. So you don't have to do turn
Awesome.
anything. You don't have to turn anything.
Thank you.
Thank you.
Anything there's okay. I will see you guys. Oh, I have office hours tomorrow. I don't know if you guys need them or not, but I have office hours tomorrow too at noon and 6.
Professor, will we have any of the monetary unit sampling stuff on there?
Nope.
No, okay, just mainly the handout.
Yeah, the sampling is all done separately, and that'll be done. That will probably like around like 12 or something like that. But the and I'll have a practice exam for that. We'll kind of review everything before you take it.
Okay,
Yeah, none of that monetary unit stuff.
okay, thank you.
All right.
Good night.
Good night.
Thank you.
Thanks, guys.
Thanks. Bye.
Thank you. Have a good one.
Have a good night.
Good night.